Okay, let's pull back the curtain on a truly intriguing business. Welcome to the deep dive. We're here to sift through the complexities, find those core insights that genuinely help you understand what's going on. Today, our focus is Berkley Corporation, WRB for short. They're a pretty big player in the property and casualty insurance world. It's a sector that often seems a bit impenetrable from the outside, but as you'll discover, their story is, well, anything but straightforward. Our source material for this deep dive is a really comprehensive investment analysis. It offers an almost like X-ray vision into this Fortune 500 company. It's a detailed look at how WRB has consistently carved out its own path, not just surviving, but really thriving. And that's in an industry that demands, well, both serious financial prudence and pretty agile decision-making.
Yeah, what's truly fascinating here is watching how a company in what seems like a very traditional industry can actually innovate and carve out such a distinct high-performance path. Our mission today is really to move beyond just the headlines. We want to understand the intricate underlying mechanisms that define WRB as, well, a unique player, to truly grasp how they manage to deliver such superior financial results so consistently, year after year, and also to dissect the critical factors that shape its investment profile. It's really about digging into the how and the why behind their operational excellence.
That's a strong statement, and it sets a high bar for what we're aiming to uncover today. Given how complex insurance is, can we really peel back enough layers to give, our listeners a truly clear understanding, especially how a company like WRB consistently outperforms when, let's be honest, there are some pretty contentious analytical points swirling around. We're definitely going to unravel some surprising insights into how insurance companies really build wealth, and we'll offer a balanced perspective acknowledging WRB's undeniable strengths while squarely addressing some significant questions it faces. I'm confident we'll hit upon a genuine revelation, maybe an aha moment, particularly when we explore the dual nature of its profitability and that specific, rather sticky point of analytical contention around its balance sheet.
Indeed. And to guide our exploration, we'll navigate through several core themes, right? We'll start by delving into the remarkable resilience and, frankly, the strategic advantages of its highly decentralized operating model that really sets it apart. From there, we'll uncover the secrets behind its dual-engine profitability, that powerful synergistic blend of underwriting discipline and shrewd investment acumen. Then we'll tackle what is arguably the most intriguing and closely watched debate around the company, the adequacy of its loss reserves. That's a big one. And finally, we'll look at WRB's strategic positioning within the high-growth specialty insurance market and, how it plans to sustain its trajectory going forward.
Okay, so let's dive straight into what truly defines W.R. Berkley, its distinctive operating model. When most of us picture a Fortune 500 company, we often think, monolithic, top-down, very centralized structure. But WRB just defies that expectation. It's not a single giant entity. Instead, it's structured as nearly 60 distinct semi-autonomous operating units. Think of it less as a singular corporate behemoth and more like a federation of specialists. It's a good way to put it.
Yeah.
Just imagine for a moment the sheer agility this allows. While some of its huge competitors might move like, well, an oil supertanker trying to steer the whole enterprise in one direction, WRB's model lets its smaller, specialized units pivot and adapt much faster, like a fleet of nimble speedboats maybe.
Exactly.
Each unit essentially functions like its own entrepreneurial startup, but, and this is key, with the huge advantage of being backed by the financial strength and resources of a massive parent company. It's a fascinating, almost paradoxical approach, especially in such a mature industry.
The strategic thinking behind this model is, well, it's foundational to their long-term success. It's not just compelling on paper. By giving significant local authority and decision-making power to each unit, they really cultivate a deep entrepreneurial spirit across the whole organization. And this isn't just about culture, it's a critical operational design choice. It empowers these units to develop incredibly deep, specialized expertise within very specific market niches. We're talking really focused areas like designing bespoke cyber insurance policies for complex tech firms, or tailoring coverage specifically for huge construction projects, or developing really nuanced insurance for cutting-edge life sciences companies with unique risks. This intense local focus is absolutely paramount. It allows WRB to strategically target markets with higher profit margins and, frankly, more complex risks. By doing that, they skillfully navigate around the intense, often commoditized price competition you see in more standard insurance lines. For you as a listener thinking about competitive advantage, this model shows exactly how WRB can stay close to the customer. They gain intimate knowledge of specific client needs and industry trends. And this proximity lets them adapt quickly to changing market conditions and pricing dynamics. That's just crucial in the P&C industry, which is famously cyclical, right?
Right.
This isn't just a business model, it's a core part of their competitive advantage. It directly enables their renowned cycle management strategy. They can expand aggressively when prices are good, or conversely, pull back and protect margins when the market gets soft. And they can do it much more easily than a big, centralized giant.
That's a really great point about managing the cycle.
Huh.
So it's not just a free-for-all, though, where these units are totally independent. There's a crucial balance, isn't there?
Oh, absolutely.
While they have remarkable autonomy, they aren't just left to their own devices. They're strategically backed by substantial centralized resources that provide both scale and security. We're talking robust, company-wide capital management, a sophisticated investment strategy, the ability to buy reinsurance together efficiently, and access to high-level actuarial, financial, and legal support.
Precisely.
So when we say it's the best of both worlds, it really seems to be. You get the nimbleness, the drive, the market expertise of small businesses,
Right.
combined with the financial strength, deep pockets, and specialized support of a major corporation.
That's it, in a nutshell.
Okay, so we understand how they structure the business. Let's look now at how they actually make money from that structure. The real secret sauce for a powerhouse like WRB seems to lie in what we're calling its dual-engine profitability. This powerful mix of both underwriting and investment skill, it seems like a mastery that truly sets them apart. Many insurers might be good at one, but WRB really fires on both cylinders, right? How does that dual approach work, and what makes it so effective for them?
That's a crucial distinction, yeah. And here's maybe that aha moment you mentioned. What truly sets WRB apart isn't just having two profit engines, it's the sophisticated, almost symbiotic way they manage them. It's really clever. They actively adjust their underwriting exposure, sometimes even shrinking certain business lines, which takes discipline to generate excess cash flow. Knowing they have an equally robust, actively managed investment engine ready to capitalize on broader market conditions.
Ah, okay. So they're playing offense on both sides, essentially.
Exactly. This dynamic integration, this constant interplay between disciplined underwriting and smart investing, that's where the real genius lies, I think. It allows them to thrive even when one engine might be facing headwinds. Their long-term strategy is meticulously built on three core pillars that work together. The first pillar is superior risk-adjusted underwriting. WRB's basic philosophy is absolute. They prioritize underwriting profit, period, full stop. This isn't about chasing market share just for the sake of it. It's about being the most profitable in the lines they choose to be in.
Which requires saying no sometimes, I
Yeah.
imagine.
A lot of times, probably. They achieve this through incredibly rigorous risk selection, basically, picking which risks to take and at what price, combined with what they call cycle management. To elaborate on cycle management, this means they proactively expand their underwriting and deploy capital more aggressively in hard markets. Those are periods with rising premium rates, tighter policy terms, generally a good pricing environment for insurers. Conversely, they make the disciplined call to strategically shrink their business in soft markets periods where competition drives prices down and terms broaden. Their priority shifts to protecting margins over just growing premiums.
Makes sense.
And to further manage volatility, they mostly focus on products with low individual policy limits and defined aggregate limits. This reduces exposure to single, massive claims. This discipline is proven by their consistent achievement of a profitable combined ratio. That's the key metric, right?
Right? The lower the better. Below 100 means profit.
Exactly. A combined ratio below 100% means underwriting profit, and WRB consistently operates well below that, showing they can price risk profitably. The second pillar, just as critical, is above-market risk-adjusted investment returns. While underwriting is foundational, their investment strategy is a powerful force multiplier. It's managed for total return, but with a very clear eye on risk. The core is anchored by high-quality, diversified fixed-income securities, bonds, basically.
But not just buy and hold.
No, not passively managed at all. It's actively managed, especially for duration, to respond dynamically to interest rate changes. So managing duration means they're not just holding bonds until they mature. They're constantly tweaking the sensitivity of their bond portfolio to where they think rates are going. For instance, if they think rates are rising, they might shorten the average duration.
So they get their cash back sooner to reinvest at higher rates.
Precisely. Allows cash flows from maturing bonds to be reinvested sooner into higher yielding assets. Captures the benefit. Conversely, if they expect rates to fall, they might extend duration to lock in the current, more attractive yields for longer.
Smart.
This active, almost predictive management of duration is crucial. It optimizes investment income and manages interest rate risk really effectively. It provides a consistent source of superior returns. But what truly sets their investment strategy apart, I think, is their meaningful allocation to alternative assets.
Yeah, okay, what kind of alternatives are we talking about?
This includes careful investments in specialized funds, direct real estate holdings, and notably, a significant merger arbitrage portfolio.
Merger arbitrage. Can you break that down simply?
Sure, it's a sophisticated strategy. Basically, you invest in companies involved in announced mergers or acquisitions. The goal is to profit from the small difference or spread between the announced deal price and where the target company stock is currently trading. It usually trades a bit lower due to the risk the deal might not close.
Okay. Try and gap that gap.
Exactly, and it's a strategy designed to seek returns that are largely uncorrelated to the big swings in the stock or bond markets. So it adds diversification and stability to their overall returns. This strategic allocation shows they're willing to pursue complex but hopefully uncorrelated return streams. And finally, the third pillar, prudent capital management. This involves maintaining an optimal capital structure, making sure they have plenty of financial strength for claims and unexpected shocks, while also allocating capital efficiently on a risk-adjusted basis to their most profitable operating units. This is where their disciplined approach really shows up in their shareholder-friendly policies. They have a long, consistent history of returning excess capital.
How do they do that?
Through a flexible policy, regular quarterly dividends, plus periodic special dividends when earnings are really strong, and opportunistic share buybacks too.
So for you as a listener thinking about investments, this directly translates into consistent shareholder value creation.
Right. And it shows a management team focused on long-term health and growing book value per share, not just chasing short-term earnings that might encourage too much risk.
The model and the strategy certainly sound solid. But let's shift focus now to the people, the leadership and governance that underpin this whole thing. At the helm, we've got the founder, William R. Berkley, as executive chairman, alongside his son, W. Robert Berkley Jr., who's the president and CEO.
Yeah, and this represents a truly rare dynamic in today's corporate world. Having a long-tenured, founder-led management team stretching across generations, it provides an extraordinary level of strategic consistency and an inherently long-term perspective that you just don't often see in public companies anymore. They're clearly not just managing quarter to quarter. Their decisions seem framed within a multi-decade view. But crucially, what genuinely sets WRB apart in terms of governance is that exceptionally high insider ownership.
How are we talking?
Around 23.3% of the company's outstanding shares are owned by insiders, mostly the Berkley family.
Wow, that's substantial.
It is, and this raises an important question. What does it really mean for you as an investor when management owns so much skin in the game? Fundamentally, it means there's an incredibly strong alignment of interests between management and public shareholders. Almost perfect alignment, you could argue.
Unlike many companies where execs might own just a tiny fraction.
Exactly, where insider ownership might be low single digits. This owner-operator dynamic deeply embeds a stewardship culture. Every decision seems meticulously weighed for its impact on sustainable, long-term value creation, prioritizing things like book value per share growth and consistent profits, rather than just hitting short-term earnings targets that could, elsewhere, incentivize taking too much risk. A powerful real-world example is their willingness to actually shrink certain business lines, like their casualty reinsurance book, when they felt pricing wasn't adequate.
They walked away from revenue.
They did. It clearly showed a preference for profit over just volume. That's a true sign of long-term owner-led discipline, right?
Absolutely. And it's not just about that powerful family leadership. They also have a robust formal governance framework, like a board with a majority independent directors, clear separation of chairman and CEO roles.
Right, which is a key aspect of modern governance.
And a comprehensive structure for risk oversight, including a dedicated enterprise risk management committee.
Yeah, it seems like a holistic approach, balancing that entrepreneurial spirit with institutional checks and balances.
Okay, let's broaden our view now and place W.R. Berkley within the bigger industry and economic picture. The P&C insurance market is inherently cyclical, we know that. It alternates between hard and soft markets. And we've been navigating a particularly interesting period from, say, 2022 through early 2025, largely defined as a hard market.
Precisely. A hard market is characterized by several key factors that are generally good for insurers. Rising premium rates, much stricter underwriting standards, and, as a result, usually improved profitability across the industry. As of Q2 2024, the commercial lines sector had seen its remarkable 27th consecutive quarter of average rate increases. It's a long run of pricing power.
27 quarters.
Yeah, quite something. However, it's also important to note we are now seeing some moderation in those increases, which could signal the gradual approach of a market softening.
The pendulum might be swinging back.
Could be. Now, the broader macro environment has been this dynamic mix of a significant headwind and a powerful tailwind for insurers. On one hand, high economic inflation has been a substantial headwind. It directly drives up claims costs everywhere: auto repairs, construction materials, medical expenses for injuries.
Making payouts more expensive.
Exactly. That inflation erodes profitability by increasing the cost of future obligations. But in contrast, the aggressive central bank interest rate hikes used to fight that inflation provided a powerful, maybe overlooked tailwind.
Okay, so how do rising rates specifically help an insurer like WRB? Connect that for us.
Well, insurers manage massive investment portfolios, right? Mostly fixed income assets. As their existing investments mature, the strong operating cash flow they generate from those higher premiums can be strategically reinvested at much higher current yields.
Ah, so the new money coming in earns more.
Exactly. This directly and significantly boosts their net investment income. It creates a particularly favorable environment for disciplined underwriters like WRB. It allows them to capitalize on both strong underwriting margins and higher investment returns at the same time. For example, in 2024, we saw average rate hikes of about 7.9% in commercial lines, excluding workers' comp. That directly boosted their underwriting income, which in turn generated a record $3.7 billion in operating cash flow for 2024. That's a huge pool of capital that could then be put into these higher-yielding investments. It creates this powerful, accelerating, virtuous cycle of profitability.
We've also seen other industry challenges, though, like a tough reinsurance market, making it pricier for insurers to offload risk, and of course the constant threat of big catastrophe losses. WRB wasn't immune, right? They reported around $300 million in cat losses in 2024.
That's right, about $300 million. It highlights the inherent volatility, doesn't it?
It does.
But despite those challenges, WRB seems uniquely and strategically positioned to benefit from the really strong growth dynamics in the specialty insurance sector. This part of the P&C market isn't just growing, it's expanding much faster than the broader, more standard P&C industry. Projections suggest the global specialty insurance market could potentially top $279 billion by 2031. That's a compound annual growth rate of 10% or even higher.
So why is specialty growing so much faster?
Fundamentally, it's driven by the increasing complexity of risks coming from new and rapidly evolving sectors. Think about the sophisticated demands of cybersecurity risks, the exposures in advanced tech, the intricate liabilities in life sciences, or the unique challenges in renewable energy. These industries face highly specialized risks that standard off-the-shelf policies just can't cover adequately. Plus, you have a rising tide of litigation and stricter global regulations fueling demand for specialized liability coverage. Things like directors and officers, D&O, professional liability, errors and omissions, E&O.
Businesses need more tailored protection.
Exactly. They're increasingly seeking customized, flexible solutions for these complex exposures. So for you, as a listener looking at long-term trends, this is crucial. WRB's entire decentralized model is purpose-built. It's strategically aligned to provide these exact, tailored, high-margin solutions. It makes them a direct and long-term beneficiary of these powerful secular trends.
Okay, but that brings us to a critical forward-looking challenge: the likely softening of the broader commercial insurance market. As those rate increases moderate, maybe even decline, competition is bound to heat up, right? How will WRB, with its disciplined approach, maintain its profitability when others might start chasing business on price?
That's the million-dollar question for the next phase of the cycle, isn't it? It will truly test their commitment to that cycle management discipline.
Okay, let's turn our attention now to the hard numbers. Let's see how this disciplined approach actually shows up on the scoreboard, so to speak. WRB's financial path over the last 2 years has been, well, pretty impressive. Consistent strength.
Absolutely. The company's shown consistent and robust top-line growth. It's a testament to both good market conditions and WRB's skillful execution. Total revenues grew significantly, from about $8.1 billion in 2020 to a record $13.6 billion in 2024. That's serious expansion. Net premiums written, or NPW, that's a core metric showing premiums written during a period, also hit a new record of $12.0 billion in 2024. That was a very solid 9.3% increase year over year. And this strong growth actually carried into this year, too, with a record NPW of $3.4 billion in the second quarter of 2025. However, maybe hinting at that softening market we just talked about, management did slightly moderate its full year 2025 premium growth outlook. They adjusted it down from a prior range of 10-15% to 8-12%.
So tapping the brakes slightly.
Potentially. For you as a discerning observer, this adjustment isn't necessarily bad news. It strongly suggests a more cautious, disciplined stance on growth going forward, which is exactly what you'd expect from a company committed to cycle management, right? Prioritizing profit over just volume.
Makes sense. And underwriting profitability, as we've hammered home, is really a cornerstone for them. How do the numbers reflect that commitment?
Their combined ratio is the clearest sign, and it tells a compelling story: consistent profitability. For the full year 2024, they reported a highly profitable consolidated combined ratio of 90.3%.
Meaning they made almost 10 cents profit on every premium dollar before investments.
Exactly. And that strong performance continued into Q2 2025 with a combined ratio of 91.6%. Now, to get an even clearer view of their underlying performance, excluding the noise from catastrophes and prior year reserve changes, we look at the accident year combined ratio ex catastrophes. On that basis, WRB looks even stronger. It was an impressive 87.7% in Q4 2024 and 88.4% in Q2 2025. These figures show exceptionally strong, consistent core underwriting results, puts them right at the top of the industry.
All right, let's confront the elephant in the room now. That really contentious issue of loss reserve adequacy. Here's where it gets really interesting and, undeniably complicated. This brings that analytical debate right into focus.
You're absolutely right. This is a critical and, frankly, multifaceted area that needs a closer look. Loss reserves, just to recap, are the funds insurers set aside to pay future claims that have already happened. Their accuracy is paramount to financial health. For WRB, this has become a significant point of contention. You've got conflicting data, different analytical views. It makes it a crucial area for any potential investor to really understand.
So what's the concern, specifically?
Well, on one hand, some external analysis has flagged WRB as having potentially the worst positioned reserves among its peers. This concern seems specifically centered on a perceived deficiency in reserves for what's called other liability occurrence, or OLO lines.
OLO lines?
Yeah.
What makes those tricky?
They are notoriously challenging. The event triggering a claim might have happened years, even decades ago. Think long-tail asbestos claims, complex environmental cleanup, intricate product liability. The full extent of the damage, or even who's responsible, only becomes clear much later, unlike, say, a car crash claim, which settles relatively quickly.
So the payout tail is really long.
Incredibly long. This makes accurate reserving inherently difficult, and it's highly susceptible to evolving legal views, jury awards, social trends. External analysts, using sophisticated actuarial models, compare WRB's historical loss patterns for these specific long-tail OLO lines against industry benchmarks in their own models. They might point to periods where WRB's ultimate loss estimate showed higher volatility or less favorable development compared to peers over time. This kind of analysis raises red flags about potential future adverse development, meaning they might need to add significantly more money to these specific reserves later.
Which would hit future earnings directly.
Exactly. A direct and potentially material charge against earnings down the road.
Okay, but what does the company itself say? What did their filings show?
Right, because the company's own regulatory filings and financials present a different, seemingly contradictory picture. In its 2024 10-K filing, WRB reported net favorable prior year reserve development of $4.4 million. Favorable development means that for claims from previous years, the actual claims payouts turned out to be slightly less than what they had originally estimated and reserved for.
Implying the reserves were actually a bit redundant, not short.
Correct. It suggests the initial reserves were slightly conservative, at least in aggregate, for those prior years. Furthermore, there's another data point from statutory filings often overlooked: WRB's incurred, but not reported, or IBNR, losses. As a percentage of total reserves, their IBNR ratio has actually increased more significantly than the industry average since the last soft market.
Okay, what does IBNR mean again, and why does that matter?
IBNR is the estimate for claims that have already happened, but the insurer hasn't been notified about yet. It's their best guess for the backlog. Generally, a higher IBNR ratio is seen as a more conservative reserving posture, setting aside more for the unknown, essentially, which analysts usually view positively.
So this creates a fascinating and, as you said, material contradiction for anyone trying to understand this.
It really does. How do you reconcile these two very different pictures?
On one side, external warnings about potential shortfalls in very specific, tricky, long-tail OLO lines. And on the other, the companies overall reported favorable development and what looks like a conservative IBNR stance.
It raises that important question. If claims trends for these long-tail lines did turn unfavorable, how would WRB's earnings be hit? The potential for material reserve increases would mean a direct, significant charge to earnings, potentially surprising the market. So while the company reports favorable development overall, those specific external concerns about long-tail OLO lines can't just be dismissed. They need diligent scrutiny, especially given the complexity, the long payout periods, and their susceptibility to external factors like social inflation.
Social inflation, that's not just regular inflation, right?
No, it's critical, especially for long-tail liability. It's the phenomenon where claim costs escalate due to things like bigger jury awards, more lawsuits, changing societal views on corporate responsibility. A claim that might have settled for, say, $1 million a decade ago could attract a $10 million verdict today due to shifts in legal precedent or public sentiment.
Making future payouts incredibly hard to forecast.
Exactly. It adds this layer of unpredictable risk that WRB, like all P&C insurers, has to constantly grapple with in their reserving.
That's a profound and absolute crucial point. It really underscores the complexity here. Let's pivot now to the second engine of profitability, the investment side. How has that performed, especially with the recent macro shifts?
The investment portfolio has been an incredibly powerful growth driver, especially benefiting from that rising rate environment we discussed. Net investment income, NII, grew by a substantial 26.6% to a record $1.3 billion in 2024. That's a huge contribution to the bottom line. And that strong trend continued right into 2025, hitting a new quarterly record of $379.3 million in Q2.
And that's mostly from reinvesting at higher rates.
It's a direct result, yeah. Reinvesting those record operating cash flows at higher prevailing interest rates, maximizing returns from their asset base. As of Q3 2024, their total investment portfolio was substantial, $27.8 billion. It's mainly anchored by high-quality fixed maturity securities bonds valued at $22.7 billion. But reflecting that diversified approach, they also have meaningful allocations to alternative assets. About $1.6 billion in specialized investment funds, $1.3 billion in direct real estate, and $1.0 billion in other equity securities. And that unique component, an $820 million arbitrage trading account, specifically doing merger arbitrage, aiming for those uncorrelated returns.
And what about regular stocks, their 13F filings?
Right. Their publicly traded stock holdings totaled around $1.9 billion. And it's interesting to see the concentration. Significant positions in energy infrastructure, Kinder Morgan, enterprise products partners, energy transfer alongside big tech names like Amazon and Salesforce.
So a mix of income and growth plays there too.
Seems like it. The portfolio construction reflects both a disciplined core and the strategic allocations to boost total returns.
So combining that disciplined underwriting with this robust investment performance, what's the overall profit picture look like?
Well, the synergy has definitely led to record profitability. WRB reported record net income of $1.76 billion in 2024, a big jump from $1.38 billion the year before. That translated into diluted EPS of $4.36 for 2024. Their return on equity, ROE, is really the standout metric. It truly shows their outperformance, an impressive 23.6% in 2024.
23.6%, that's huge for an insurer.
It is, and it marks the third straight year their ROE topped 20%. That's way above their own long-term target of 15% and puts them firmly in the top tier of the whole P&C industry. For long-term value creation, book value per share, BVPS, is also critical. In 2024 alone, BVPS grew by a very strong 23.5% before dividends and buybacks, and cumulatively 81.9% growth over the 5 years ending 2023. That shows consistent compounding of shareholder value.
And how about their capital structure and returning value to shareholders? Does all that cash generation translate into meaningful distributions?
It absolutely does. The strength of their core business is clear in their operating cash flow. It grew 25.6% to a record $3.7 billion in 2024. This robust internal cash flow fuels both reinvestment and growth and critically significant returns to shareholders through that clear, flexible capital return policy. In 2024, WRB returned a substantial $836 million to shareholders.
So how's that split?
$532 million in dividends. That includes regular quarterly payments and those periodic special dividends when earnings are extra strong, plus $304 million in opportunistic share buybacks. This flexible approach really underscores their commitment to managing capital effectively while rewarding long-term shareholders. Now, if you look at the numbers from our source material, the 5-year financial summary, you can really see these powerful trends. Looking at 2024, total revenues passed $13.6 billion, net premiums written near $12 billion.
Great number.
Huge. And that translates directly into net income of almost $1.8 billion, ETS of 4.36 cents, leading to that stellar 23.6% ROE, all while keeping that highly efficient combined ratio around 90.3%. The consistency across these key metrics, especially ROE, it really highlights their discipline and ability to generate superior returns. For you, this isn't just numbers, it's tangible evidence of operational excellence.
That's a fantastic financial picture internally. But now, how does W.R. Berkley really stack up against the competition? Where do they fit, and how do they perform compared to others in this complex landscape?
Well, WRB operates in a highly competitive market, right? Specifically specialty and broader commercial P&C. Their peer group is quite diverse. You've got other pure-play specialty insurers like Arch Capital and Kinsale Capital, but also larger diversified global carriers with big specialty operations. Think Chubb, Travelers, The Hartford. And competition isn't just about price. It's fiercely fought over coverage terms, financial strength. WRB's A+ rating from AM Best is a big plus there, service quality, and crucially, relationships with brokers and agents.
Okay, let's get quantitative. How do they really compare on the numbers when you put them side by side?
When we benchmark WRB against its peers, its performance consistently stands out. Profitability-wise, that 2024 ROE of 23.6% is exceptionally strong. It significantly outperforms Arch Capital's P&C Ops ROE of 15.3% and easily beats many others. For underwriting performance, their core strength, WRB's 2024 combined ratio of 90.3% is highly competitive, very disciplined.
How does that compare specifically?
Well, Travelers reported 92.5%, Arch Capital P&C had 94.8%, Chubb is often seen as best in class at 86.6%, but WRB is clearly operating right there in the top tier. Growth-wise, WRB's 9.3% NPW growth in 2024 compares favorably to Travelers' 8% and Chubb's nearly 10% in global P&C. Arch Capital did report higher 17% growth, but remember that was significantly boosted by a big acquisition, so WRB's organic growth looks quite robust.
And what about valuation? How does the market price them?
Valuation. The market unequivocally assigns a premium to WRB. Its price-to-earnings ratio usually trades in the 16-17x range. That's notably higher than Arch at 9-11x, Chubb around 13x, Travelers around 12x. Similarly, its price-to-book ratio of about 2.9x is a significant premium to peers like AIG at 1.1x or Markel at 1.4x.
So the market's clearly saying it expects continued outperformance.
Exactly. It indicates strong market confidence in their consistency, discipline management, and future prospects. And what's truly fascinating here, a critical insight for you, is that despite the inherent risks of insurance, the market sees WRB as remarkably stable. This shows up in its very low beta of 0.39.
Beta meaning volatility relative to the market.
Correct. And WRB's is even lower than Arch Capital's 0.49. This suggests a perceived lower risk profile, greater resilience in downturns, a testament to their consistent profits and disciplined capital management. Now, if you mentally picture that peer group comparison table from our source, you see WRB standing out. That 9.3% NPW growth, the excellent 90.3% combined ratio, leading to that impressive 23.6% ROE, all top tier.
And then the higher valuation numbers reflecting that.
Exactly. The PE of 16.3, PB of 2.9 clearly highlight the premium the market gives them, and that low beta of 0.39 reinforces the perceived stability.
Beyond just the numbers, what are the key qualitative differentiators? What really sets them apart?
Their key qualitative advantages are genuinely unique, hard to replicate. First, that decentralized model giving agility and market closeness. Second, the deep specialization of their underwriting units, letting them excel in complex niches. Third, the profound influence of that founder-led culture, backed by high insider ownership, breeding long-term thinking. And finally, their proven, disciplined track record of cycle management.
Are there any downsides to their model?
Well, relative disadvantages exist. Compared to giants like Chubb, WRB has less global scale and brand recognition. That might matter for huge multinational clients. Also, their focus on specialty lines, while a strength, could theoretically expose them more acutely if something really bad happens in one of those specific niches. Diversified players might have other businesses to cushion such blows.
Okay, so after covering their model, financials, and competitive standing, what does this all mean for where WRB is headed? Let's talk about recent strategic moves and forward-looking factors.
Yeah, recent strategic initiatives definitely show a proactive stance from management. For instance, forming Berkley Edge in August 2025 is pretty significant. This new unit focuses on professional liability and casualty for small to mid-sized businesses with hard-to-place risks, sold via wholesale brokers.
So doubling down on their specialty expertise.
Exactly. It deepens their commitment to the excess and surplus E&S market, where WRB already has core expertise and often finds better margins. Launching this during a potentially softening market suggests management sees durable opportunities in complex segments. Even if broader pricing eases, it shows confidence. Similarly, the earlier launch of Berkley Embedded Solutions in March 2025 points to a focus on tech innovation and adapting to how customers buy insurance.
Embedded solutions, meaning integrating insurance into other platforms.
Precisely. Using tech and data to offer tailored insurance directly at the point of need, integrating it seamlessly. It's a proactive strategy to adapt to changing habits, meet digital demands, and modernize. Positions them to capture business from new channels.
And there was a major external validation recently too, right? Something that really speaks volumes.
Indeed, a very significant one. In March 2025, Mitsui Sumitomo Insurance, MSI, a major Japanese P&C insurer, a sophisticated global player, agreed to acquire a substantial 15% stake in W.R. Berkley.
15%, that's a huge vote of confidence.
An incredibly powerful external validation. An investment like that from such a peer implies extensive due diligence. It arguably de-risks WRB for other investors. It implicitly endorses their model, management, strategy, and, critically, maybe even their reserving practices in the eyes of another major player. Plus, it could open doors for future collaborations.
Despite all these positives, what's the general feeling among analysts, and what key risks remain?
Well, the consensus rating among Wall Street analysts is currently a hold, actually. It's a mix of recommendations, not a strong buy. This suggests analysts acknowledge the strong operations and financials, but they're also carefully weighing that against the premium valuation and, notably, those lingering questions about loss reserves, especially long-tail casualty.
So admiration, but with some caution baked in.
That seems fair. Which leads us back to the key risk factors we've touched on. They really bear repeating. The primary unavoidable risk is industry cyclicality. A long, soft market could inevitably pressure WRB's growth, underwriting profits, and overall returns. Then, as we detailed, loss reserve uncertainty remains the most significant company-specific risk, particularly for those complex long-tail casualty lines. This raises that important question for you as an investor. If claims trends there turn unfavorable, how badly could earnings be hit? Material reserve increases mean direct charges to future earnings. Could surprise the market.
Can't ignore that one.
Absolutely not. Then there's catastrophe exposure. WRB faces substantial losses from natural and man-made disasters, hurricanes, wildfires, etc. The increasing frequency and severity of weather events, possibly linked to climate change, complicates risk modeling, pricing, reinsurance, adds unpredictable volatility. Investment market volatility is always a risk, too. A big chunk of their earnings comes from investments. A sharp downturn in markets or spike in defaults could hurt results, capital, and book value. And finally, competition. It's always intense. Existing players, new entrants, sometimes you see irrational pricing, forcing difficult choices.
What an illuminating deep dive. We've really peeled back the layers on W.R. Berkley, haven't we? Journeying through its unique world, its specialized, decentralized model, the disciplined execution on both underwriting and investments, right through to that contentious but critical debate around loss reserves. It's a remarkable mix of agility and financial discipline.
Yeah, in a final assessment, W.R. Berkley is undeniably a high-quality operator in specialty insurance, no doubt about it. Its core strengths, that agile model, the founder-led influence with high insider ownership, the exceptional long-term financial track record, those are formidable advantages. However, for any discerning learner or investor, these strengths must always be balanced against significant risks. The industry cycle, cat losses, and crucially, that unresolved analytical debate surrounding the adequacy of its long-tail casualty loss reserves.
And the market, for its part, clearly recognizes something special here, rewarding WRB with that premium valuation we talked about.
Precisely. So the central question for any curious learner or potential investor really becomes this. Can W.R. Berkley's durable competitive advantages and its proven discipline continue to justify that premium valuation, especially as it navigates the inherent uncertainties of the P&C cycle and those persistent questions around those notoriously tricky long-tail loss reserves? What stands out to you about how they manage these competing forces? How do they strike that balance between growth, profit, and prudent risk management?
That's a powerful thought to leave you with. It really encapsulates the core challenge and opportunity here. Thank you so much for joining us on this deep dive into W.R. Berkley Corporation. We hope you've gained a clearer, more nuanced, and truly insightful understanding of this fascinating company and the complex world of specialty insurance. Keep exploring and keep questioning.